Hello ladies and gentlemen, and a very warm welcome indeed to today's webinar, which is brought to you by sharedserviceslink.com and sponsored by Ariba. Many of you will be very aware that during the summer period, Ariba, along with sharedserviceslink.com, ran a survey, and the intention of that survey was really to understand some key trends that were taking place within Europe, specifically around the electronic invoicing space. So I'm very pleased that today we've got James Tucker joining us from Ariba. He's going to be sharing with us some of the key findings from that survey, and in particular you'll be getting a bit more of an insight as to how your competitors are making e-invoicing a runaway success, and we really do look to be sharing with you the fascinating results of the survey that took place earlier this year. So just to recap, I'm Susie West. I'm the founder and CEO at sharedserviceslink.com, and the presenter for today, who I'm very pleased to be introducing, is James Tucker, who's the Global Solutions Marketing Director at Ariba. So ladies and gentlemen, just to bring you up to speed as to what the next 60 minutes is going to look like for you, going to touch briefly on the importance of questions and then just set the scene and explain the context as to why we're actually having this webinar today and what really you can be looking to get from it. And then I'll be handing directly over to James. And in the last 10 minutes of the webinar, that's when we look to be answering your questions. And just to be absolutely clear, you've come onto this webinar today with a very clear intent. I'm absolutely sure of that. And I just ask you as to what that intent is. What nagging question are you looking to get resolved during these next 60 minutes? Please pop that question through to me, and I will put the question to James, and he will be looking to answer that in the last 10 minutes of this webinar. So it is a two-way exchange. Please do absolutely take me up on that offer to get the answers that you seek. Remember, just to stay online for the last 10 minutes in particular. So let's have a look at the context. And why is this so timely? Why are we having this discussion at all today? My question to you is, in 2012, can you actually believe that companies, especially large corporates, the kinds of corporates that have high volumes of invoices, that run off sophisticated systems, typically run shared services, can you actually believe that they are actually still touching paper invoices today? The concept of shared services is not new to us. It's been around for 20 years. But the birth of shared services, the rationale behind that birth was to make the payables function and therefore the finance function much more efficient and effective in its delivery. But that is not what that's not the kind of the end results of the intended outcome of a shared services organization. A shared service today goes above and beyond just making the accounts payable organization effective and efficient. It's now delivering value back to the organization and actually contributing quite significantly to even to the top line. So and most definitely to the bottom line. So the role of shared services is morphing and developing. And the critical component of all of this development is the invoice. The critical document that is driving all of this change is the invoice, and the possibilities that transpire when that document is converted from paper to electronic really are very, very exciting. And the value of your shared services organization depends so greatly on converting that document from paper to electronic. And we all know this. We're familiar with this as a notion. So now it's really the difference between those who have got there and have converted to electronic and those who are still in a very paper-based world. This survey has come at a very interesting time. It's when there are opportunities out there that haven't been available to us before, and this really is the opportunity of the availability of cash. And this has a huge role and a huge role to play within electronic invoicing. And I'm going to allow James really to go into details on that later. But the dynamics between corporations having a huge amount of cash and being able to pay invoices earlier because they've taken their funds out of various investments, specifically in Europe, which poses a risk as far as investment is concerned. Corporations now have cash, and suppliers don't have cash and they're struggling to get cash if they need it from the bank. So there's a dynamic there that wasn't available 2 or 3 years ago, and it's a window of opportunity which is driving change in this market. So this survey has come at a very, very interesting time for us, and it's really the winners who are going to capitalize on this unique opportunity. The cost of doing nothing, quite frankly, it's simply not affordable. And our competitors around us, your competitors around you, they are very much on this train. So this train of change and capitalizing on these opportunities. So it's a very exciting time for us to be having this survey. And just before I introduce James, I just want to put the first poll question to you, please. There will be a series of polls which I will be asking you to participate in. So coming up on your screen now, what processes do you personally manage? And if you can tick all of those as apply. Purchase to pay, order to cash, record to report. Are you involved in procurement stroke sourcing activities? So this is really looking at spend analysis, looking at the contracts that you have with your supplier, so you can look to talk to them about discounting. Or are you involved in cash management stroke treasury part of the business? We've had 32% of you responding. We really would like to get up to 70% from the majority of these poll questions, please. Just so you're aware, if you haven't been on one of our webinars before, we always share the findings. So it's always really interesting for you as a viewer, as a participant, to see the information. The more of you that respond, the more meaningful the information. Up to 51%. If you haven't already ticked the box, please do so. It's important that you contribute. I will be closing the poll very shortly. Finally, as a final question to you, what processes do you personally manage? Purchase to pay, order to cash, record to report, procurement, sourcing activities, cash management, and or treasury. Closing the poll in 3, 2, 1. Just shy of 60% of you responded. Let's have a look at the results coming up on your screen now. Just gives us a very good overview as to who's on this webinar today. So you can see that 70% of you are involved in purchase to pay. Just over a quarter of you are also involved in cash management treasury. Just over a quarter of you are also involved in procurement and sourcing activities. So very interesting results there. So I'd now like to, on that note, introduce James Tucker, Global Solutions Marketing Director at Ariba. Over to you, please, James.
Great. Thank you, Susie. As Susie mentioned, our aim with this survey was to quantify and to qualify the ways in which finance professionals across Europe are leveraging electronic invoicing. And for this webinar, I'm going to augment some of the survey results with a benchmark and surveys from other thought leaders and from discussions and interviews that I've had with many companies that have successfully deployed e-invoicing as a strategic part of their network economic connections with their trading partners. And our aim for the webinar is to equip you with this latest thinking and to provide you with ways of making e-invoicing a strategic part of your organization's success. The strategic impact that e-invoicing is having on business commerce is it's well documented, and it's also why many governments are pushing for an e-invoicing as an important part of their digital agenda. The European Commission, as an example, wants e-invoicing to become its primary means for invoicing in Europe by 2020. And it expects that about €250 billion in savings will occur as a result of e-invoicing just over the next few years. Europe's digital agenda is part of what McKinsey calls the networked economy. It's companies that connect their back office systems with their customers and suppliers. And a McKinsey study shows that these companies that are interconnected are 50% more likely to increase sales, have higher profit margins, gain market share, and to become market leaders. Susie mentioned the train of change. And I like to use the bullet train as a metaphor for e-invoicing becoming a primary driver of process efficiency, and followed by other cars of strategic cost savings and discount capture, contract compliance, and things of this nature. We have seen many companies that are doing this already, where they've moved to 60, 70, or 80% electronic or more, and they're realizing the significant cost savings that are coming from these other areas as they advance their processes around getting rid of paper and automating the invoice. So, for example, I'll share some examples of companies that I've seen do this. Deutsche Bank, they've nearly achieved their vision for becoming over 80% electronic. They've enabled over 4,000 suppliers on the Ariba network, and they process over 500,000 invoices annually. And as a result, they've lowered their F&A outsourcing costs by about 35%. And they're also lowering costs by tying about 70% of their corporate spend to purchase orders that are validated by electronic invoices. So that's a good example of a company who has joined the networked economy and is driving significant savings with e-invoicing. So my agenda for this remaining time is to share the results of the survey. I'll begin by reviewing the survey objectives and the respondent demographics. The major themes of the survey were around three primary areas: process efficiency, cost savings, and best practices associated with electronic invoicing. So I'll discuss some of the results from each of those chapters. At the close, we'll have a brief introduction to Ariba's e-invoicing solution, and I'll discuss how companies in Europe and across the globe are using our solution to drive process improvement and cost savings, like Deutsche Bank and others. We'll have a few poll questions, as Susie mentioned, during the presentation material, and then we'll close with time to address your questions at the end. And we'll also have a link for you for downloading a copy of the research results from the survey. All right, so in around mid-2012, we partnered with sharedserviceslink.com to quantify and to qualify how e-invoicing is driving process efficiency and how companies are using e-invoicing in innovative ways to drive more strategic cost savings, and then how they're incorporating this into best practices in new and interesting ways that we want to be able to share with you. We had 184 respondents to the survey, over 50% of which were executive level. These included accounts payable directors, vice president of shared services, and CFOs. About 60% of respondents have 150,000 or more invoices annually, and 62% say that they already have some kind of an e-invoicing solution. 29% that they don't yet have an e-invoicing solution but are in the planning stages, and 9% of the respondents said that they have no plans for an e-invoicing solution. We'll pay particular attention to that category because we think it draws an interesting contrast between those with e-invoicing. So the survey results were organized around three distinct categories: process efficiency, cost savings, and best practices. I will begin with the process efficiency. Over 40% of respondents said that process efficiency was their primary objective for an e-invoicing initiative. There are many measures for process efficiency, but for this webinar we'll focus on just a few of them. So receipt to approve days. One measure of process efficiency is the elapsed time measured in days from invoice receipt to approval for payment. And as this is the first chart of many, let me take a moment to explain how the data is presented. Along the x-axis, along the bottom there, you see represented the percentage of respondents. And the color category represents an increasing number within that particular category. So in this case, number of days from receipt to approve. So the grand total line at the top, I placed a yellow diamond you see there, and it shows where there's almost 55% of the respondents processing invoices in an impressive 10 days or less. so you get a feel then for how that chart's working. In addition to the grand total result, we also show results by those with e-invoicing, those in the planning stages, and those with no plans for an e-invoicing initiative. And I'll analyze the results between those with e-invoicing and those with no plans on this chart and on several other charts, again, because I find that to be the most interesting contrast in the results. About 50% of those with e-invoicing approve invoices in 10 days or less. And so a little bit better when they have e-invoicing versus the grand total. And surprisingly, it shows that nearly 60% of those respondents who have no plans for e-invoicing also approve invoices in 10 or fewer days. And this is surprising as it contradicts what I've seen in business. It contradicts what I have heard from AP and shared services leaders in the hundreds of companies that I've had the opportunity to meet with or speak with. But this is what the survey results show, and we will see, however, that further analysis of the data shows that process efficiency for these organizations does not necessarily translate into cost savings or best practices. All right, so from a regional perspective, this next figure shows that 60% of the respondents from the United Kingdom and Ireland say that they post an invoice within 10 days of receipt. The DACH countries, on the other hand, had 30% of respondents say that less than 10 days, and then France had 70% say less than 10 days, and you can also see Benelux countries had 45% say less than 10 days. I think we're going to ask a poll question at this point, Susie, so let me turn it over to you for the poll question.
Thank you very much indeed. So we'd just like to have a look, please, at the productivity within your accounts payable organization. So how we're going to do that is just ask a question around how many invoices are processed per FTE per annum. Now, many of you might have this figure noted and regularly observed. Just in case you don't, the quick mathematical way to do it is really to have a look at the volume of invoices coming in each year, say 100,000, and the number of people in your AP department who are actually dealing with those invoices. And we generally include all those people who are involved in supplier inquiries as well on the help desk. The number of people in AP, not just the people potentially keying or touching the invoices, but all the people in AP. And you do the math to see how many people you've got actually processing those invoices, and that gives you your productivity number, how many invoices processed per FTE per annum. So we've got less than 10,000, 10,000 to 20,000, 20,000 to 30,000, 30,000 to 50,000, or more than 50,000 invoices processed per FTE per full-time equivalent each year. We are looking to get these numbers up, so if you're not sure about it, I've given you the simple formula that we generally use, so please just do a quick sum and tick the box that is most appropriate for you. We're only at 50%, so if you haven't responded, I do ask for you to participate, please. Closing the poll in 3, 2, 1. Okay, we're at 53% there. Coming up on your screen, an interesting shaped pyramid, if you will, with 6% of you, congratulations, at a productivity rate of more than 50,000 invoices processed per FTE per annum. At the other end, we've got 33% of you with one individual in your team processing less than 10,000 invoices per annum. Interesting results. Back to you, please, James.
Great. Yeah, it's interesting, and I would say probably about what we would expect. So let me go through the numbers from the survey, and I'll also share some numbers from outside source, in this case the Hackett Group. I like this measure as a measure of process efficiency. I think well, cost per invoice is usually one of the most popular measures when I'm speaking at conferences. That's what people want to discuss. But what I find is that the definition of cost per invoice, it varies widely. And it can be very difficult to measure across regions or across industry. So this metric is much more easily attainable. Susie, I think you articulated it nicely. It is a simple formula. And I think, therefore, perhaps the easiest way to uniformly measure process efficiency. Our survey results had a medium number of invoices per full-time equivalent of about 13,000 invoices. And I think that's pretty consistent with the instant poll that you just did. Now, 13,000, you can see, is slightly higher than this recent Hackett group benchmark, which showed over 8,000 invoices per FTE per annum. In this case, it was, you can't see the label properly, but it should say non-top performers, 9,109. And the best in class is 32,830. And then those that are automating invoices are at 11,000. Those that are not automating are less than 7,000. They're at 6,797. So our survey, the median of our survey was about 13,000. So they were automated, not quite best in class, but sort of fitting within this chart pretty nicely. And I think the goal really would be to get to that best-in-class number, and that is going to require automation and also a look at some of the other measures of process efficiency that fall around number of invoices per FTE, which could be supplier inquiries. It could be your organization type and those things, and we'll discuss more of that as this webinar continues and we discuss some other areas of the survey. All right, so let's look at another measure of process efficiency, which is an ability to comply with VAT regulations and requirements. This one, I decided to put more qualifying remarks rather than quantified results numbers. What we found in the survey was that pretty consistent that VAT compliance was not a major driver for e-invoicing adoption. It was certainly a consideration, but not the major driver. Process efficiency, cost savings was the strong driver for adopting the e-invoicing solution. But it was identified throughout that e-invoicing can and does help with VAT audits. It helps keep up with the ever-changing country-specific rules, and it was perceived by many of the respondents to be an area of risk, where some of those quoted, I think you can see them here, based on the interviews that we conducted during our survey process. They suggested that with e-invoicing, they're going to get better information and better data, but they still seem to think that with e-invoicing there was you can see there, complications associated with it. The one in the left lower corner, with manual invoicing, there's a higher risk of error, but with e-invoicing, if there's a design issue, everything can go wrong. And so my takeaway from these responses is that there is technology built in with electronic invoicing that allows for digital authentication and prescriptions to country-specific VAT regulations. That would be the tax rates. It would be archival requirements and what have you. And I think those vendors that provide solutions that keep up with these changing regulations can be extremely helpful for education, and I think that's got to be part of really where this goes, is that better information and education about VAT requirements as well as vendor capabilities is probably what's essential for this particular category. So Let's shift to the next chapter of the survey results, which was around cost savings. And over 30% of the respondents said that cost savings is the driver for their e-invoicing initiative. We discussed some of the challenges of cost per invoice as a key performance measure in the section on process efficiency. A key measure of cost savings are really the number of resources required to fulfill a function. So we talked about the number of staff members processing invoices. Cost savings can pertain to opportunity cost savings as well, like early payment discounts or contracted savings, impact on working capital and cash use. In this survey, we focused on discounts as a key component of cost savings. It's a little more easier to measure and get your head around, so we'll get to that one in a second. But from sort of building off of what we just discussed with process efficiency, we want to talk a little bit about the opportunity cost that is a result of having inefficient processes. So you see here a discussion around errors and exceptions. The number or percent of invoices with errors and exceptions, you can see a couple different studies here. One from Aberdeen saying that 28% of invoices have some kind of errors and exceptions. The AP network study showing 15% of invoices have errors and exceptions. If we just take the lowest estimate, so say 15%, and that study went on to say that resolving every error and exception costs somewhere between 20 and 200 euros. So if we take the low end, the 20 euros, and then so apply, say, 15% of 100,000 invoices, that'd be 15,000 errors and exceptions at 20 euros each, that would be an incremental cost of about 300,000 euros just to resolve those errors and exceptions. So 300,000 euros for every 100,000 invoices in incremental cost. This is why I put errors and exceptions in cost savings, because I think if you can get a handle on eliminating errors and exceptions, you can really drive down your cost. In the title, you see I have smart invoicing eliminates errors and exceptions and drives 98% touchless. We'll talk later about Ariba's smart invoicing solution, because this is really what the crux of what it's going after, is trying to eliminate errors and exceptions at the point of invoice submission. We'll talk more about that later. So that's errors and exceptions. You can imagine from a supplier's perspective, they submit an invoice, probably paper, and you receive it, and it has either a quantity that's out of threshold, or the wrong unit amount, or some other error on that invoice that your accounts payable department has to deal with. Once you get it from the queue and you start dealing with that invoice, you probably find quickly that there's an error. You have to then find who the buyer was and get on the phone with the buyer and have them fix the problem. Well, that's creating significant delays with the processing that invoice. So the supplier invariably is going to get on the phone and say, hey, where's my invoice? When am I going to get paid? And that, and for other reasons of delay, drives up the number of inbound inquiry calls. I thought it was important when Susie talked about the number of invoices per AP staff that should include not just those that touch the invoice, but those that are dedicated to handling these inbound inquiry calls. It's an important way to think of it. Our survey here showed that 60% of the respondents have 20 AP staff or greater that are dedicated to supplier inquiries. That means 40% of the respondents. I'm sorry, let me say it this way: that the 40% of the AP staff of most of the respondents are dedicated to handling supplier inquiry calls. And again, when we talk about smart invoicing, I mentioned that before, that many leading providers like Ariba are going to offer a supplier portal, and that portal will provide your suppliers with real-time visibility into the invoice status, so from receipt to approve, scheduled to pay to paid, and thus helping avoid these costly supplier inquiries. Susie, I think before we get to the next cost savings, there's another poll question that we wanted to ask.
Thank you very much. So taking us into the next section, let's have a look at this poll question, which is concerning negotiated discounts and the capture of them. So how much of your negotiated discounts do you actually capture? Is it less than 25%, 26 to 50%, 51 to 75%, or 76 to 100%? Or perhaps you don't actually have any discounts negotiated, and therefore you don't look to capture them at all. So how much of your negotiated, what percentage of your negotiated discounts do you capture today? Less than 25%, 26 to 50%, 51 to 70%, 75%, or 76% to 100. Again, if you haven't responded, please do so. We do look to get as much meaningful data from webinar attendees as possible in order to issue back to you meaningful benchmarking results. So closing the poll in 3, 2, 1. Let's have a look at the information shared here. So interestingly, and I'm sure James is going to have a very interesting view on the bottom statistic, that 39% of you don't actually have any discounts negotiated at all, so therefore don't look to actually capture them. And 7%, congratulations to you, you're at 76 to 100% capture rate, and 23% of you are at less than 25% captured of your discount capturing rate. So interesting results there. Back to you, please, James.
Yeah, it is interesting, and there's a couple charts coming up that I think will correlate to the results that we see here. I think these results, for example, 23% saying that they're capturing less than 25%, 16% less than, or 26 to 50. So 39, call it 40%, are capturing less than 50% of the available discounts. 7% in this instant poll are capturing over 75% of their discounts available, and of course that would be considered best in class. Let's see. Let's get back to the slides and then look at what our survey showed with respect to discount capture. 70% of the respondents in our survey said that they capture less than half of their available discount savings opportunities. So in this instant poll, we had about let's see, 40% that said you captured less than half. So in our survey, even more of those that we surveyed said that they capture less than half of their available discounts. Those with no plans for e-invoicing have a worse discount capture rate. It's an interesting contradiction from our survey results that we showed earlier with respect to the receipt to approve cycle time, where they actually seem to do that as well if they had no plans for e-invoicing as to whether they did or didn't have e-invoicing. However, what this chart shows is that they are far worse at capturing discounts than those that have e-invoicing. It's subtle, and sometimes the way these charts are organized, it's not easy to actually glean the data off of there. But what this shows, the data shows, is that 70% of those with e-invoicing are capturing 50% or less, but 70% of those with no plans for e-invoicing are only capturing about 20% of their invoices. Why is this the case? You know, it's probably because they don't have the technology to accommodate dynamic discounting. It may also be because with paper they just don't have visibility into. I think with our instant poll we saw 40% don't even bother. They don't even have discount terms. And it may also pertain to what we'll be discussing around best practices, that they lack the organizational alignment to get accounts payable, treasury, and procurement lined up on discount programs. The next chart shows how early payment discount works. Most of you are familiar with these terms. 2%, 10, net 30 is kind of a standard term. The 2% represents the discount rate on the y-axis there on the left. The duration of the invoice, in this case it's a net 30, is represented on the x-axis on the bottom. And if you approve and pay this invoice within 10 days, you'll get a 2% discount. If you don't approve and pay it within 10 days, you pay it on net 30, the full amount. What this is showing is that according to another survey from PayStream Advisors, they found that invoices are approved on average in 21 days. Now, that means if you're approving it on 21 days, you're too late to capture the discount. Those that are able to approve it faster, and we found that a great percent of our survey respondents are able to approve and pay invoices within 10 days, so they would be able to capture those early payment discounts. But on average, most companies are not able to do that, and that's to a great extent why discounts are still not captured. But there's also more to it. The next chart shows that a Hackett study survey that was analyzing discount programs, working capital impact, and the like, comparing North America and Europe. And in this case, what they found was that where in North America, about 68% of companies have some discount strategy where they've identified the amount of cash they want to invest in a discount program, what the target rate of return is for that cash, what suppliers that they want to carve out and include in that program. Whereas in Western Europe, you see only about 35% of companies have some kind of a discount strategy in place. So I think this is also why our instant poll showed that nearly 40% of you don't have a discount program in place. Pretty consistent, I think, with what this Hackett study is showing. All right, so moving on within cost savings, another area of significant cost savings potential with electronic invoicing is in contract compliance. If you consider that most contracts are on paper, they probably sit in a file cabinet or in someone's briefcase, and consequently are difficult or perhaps impossible to enforce. With electronic contract invoice matching, these rules can be applied in real time. And according to this Hackett Group study, just by improving contract compliance by 10%, you see the chart on the right there, moving from the median to the top quartile. So in the chart on the left, 76% is the median, 86% is the top quartile. So if you improve by 10 percentage points, and on the chart on the right, you see that you move from $9.4 million of contract leakage to only $4.8 million of contract leakage. Contract leakage being it's missed contract savings, savings that you miss because you just don't have visibility into it. With contract invoicing, electronic contract invoicing, you can then close that gap and avoid leaking or missing that cost. And there's significant savings potential from that made available through electronic invoicing. So we're going to shift to best practices. And invoicing matters. They're urgent and critical for any enterprise. And we know in Europe that the European Union sees e-invoicing as a strategic component of its digital framework. And the EU Directive, which is the 2010-45 EU, it aims to eliminate barriers to electronic invoicing, and it's going to treat now electronic invoices equally with paper. And this should increase the use of electronic invoicing. And for those of you that have yet to begin this journey, now will become the time. It will be easier for you to do that. The EU will now have reduced the burdens on you to become part of the e-invoicing family. There are other aspects of best practices. So organizational constructs that we discussed earlier around to address things like VAT audits, VAT compliance, use of purchase orders, contract invoicing, discount capture. All of these things really require strong organizational structures. And so to a great extent, we're going to focus on these areas of best practices. We'll begin with look into PO invoicing. We know that a best practice in the procure-to-pay function is to require the use of purchase orders for purchasing certain goods and services. There are categories of spend that may not necessitate a purchase order. For example, low-cost office supplies or tax and some legal payments. But consequently, the percent of PO versus non-PO invoice spend, it's going to vary greatly by company. It's going to vary by region, by company size, et cetera. But it's generally considered that unless there's a strong case for not using them, the requisition of goods and services should originate with an approved purchase order. What our survey shows is that about 35% of respondents have 50% or less of their total invoice volume that's PO-based. And this varies by country. As you can see here, we saw in DOC, for example, that 85% respondents said that over 50% of their invoices were PO-backed, whereas Benelux has 50% respondents that had 50% or fewer PO-backed invoices. The next chart shows that organizations with e-invoicing have a higher percent of PO-backed invoices. And this is where those with e-invoicing and those with no plans for e-invoicing starts to become very interesting. You see that just over 30% of the respondents that use e-invoicing have less than half of their invoices that are PO-backed, while just over 40% with no plans have less than half of their invoices as PO-backed. And these findings show that companies with no plans for e-invoicing have a higher percent of non-PO invoices. This drives up the cost of processing, and it drives up the likelihood that they're going to have non-compliant purchases. Use of purchase orders and e-invoicing to validate them can help avoid, maverick spend and errors and exceptions, many of the things we've discussed. And leading e-invoicing solutions like Ariba's will offer a PO flip. It's a trademark feature by Ariba, and what it does is it allows suppliers to automatically copy data from an electronic purchase order into an electronic invoice. And this, of course, saves your suppliers time and effort in typing and rekeying this data, and of course then helps avoid costly errors and exceptions. So regarding finance organizational structures, let's just quickly define these terms. A decentralized function is one that staffs accounting functions within each business unit. A centralized function is one that rolls up to a single head office that has sort of standard systems and procedures. A shared service organization is one that then, according to Accenture here, is a high-performing organization with well-defined service management frameworks and processes. Susie, let me ask you what would you add to these definitions as someone who spends a lot of time talking about shared services functions?
Yeah, thanks, James. Yeah, absolutely. I mean, just building on the Accenture comment there, of how we define the difference between a centralized finance organization, which is literally just a centralized pool, if you will, of that activity, and a shared services organization. The gulf between the two really is quite extensive. Centralization is a component of shared services, but on top of that there are extra layers like consolidation of systems, the standardization of the processes that sit within that shared services organization, and then the automation and optimization of those transactions. And the key focus really of a shared services organization really is to continuously improve. But on top of that, there's an extra layer, which is then to treat the rest of the organization as if it's a customer. So the service management framework that Accenture is pertaining to there is absolutely fundamental to shared services, and it makes the kind of the service that you get within a shared services organization quite different to that you get within a centralized environment. So a shared services organization will have customers, will have SLAs, will have customer feedback channels, and maybe even charge for the services that they render. Takes me on to the poll, which I'll be launching now. I'm very interested to find out from you, please, if you have a decentralized finance organization, a centralized finance organization, but not shared services, or do you run a proper shared services organization? So if you can cast your vote, please, just to alert you to get your questions ready, because in 5 minutes' time we will be moving to questions. So if you haven't already submitted your question to me, please do so, or just make a note of that and make sure that you submit that to me when we move to questions in 5 minutes' time. So closing this poll, if you haven't already ticked the box, please do so. Closing the poll in 3, 2, 1. We're at just over 60% there, and coming up on your screen you can see that only 14% are running decentralized finance, with 61% at true shared services. Thank you very much, and back to you please, James.
Great. So let's compare that to the survey results that we got. We had about 9% of the respondents have a decentralized finance function, so that compares to 14% on this instant poll. 36% of our respondents in the survey had a centralized function compared to the 25% in this instant poll. And then over half of our survey respondents have a shared service function. In the instant poll, you had 61%. So pretty close, actually, I think the results are. So let's look at the distinction in the finance structures between those with e-invoicing and those with no plans. This I did find interesting, and it would have been probably interesting to do an instant poll on this as well, but nonetheless, here's the data from our survey that 61% of respondents with e-invoicing have a shared service function or a finance for finance, while only 31% of those organizations with no plans for e-invoicing have a shared service function. So a dramatic difference in finance organization structure with those that have e-invoicing, those with no plans. One other note is that almost all of the organizations that processed more than 250,000 invoices annually run a centralized finance or a shared service function. Very few had decentralized functions. All right, so there were some interesting observations about those that said that they had a shared service function. They tended to have a higher percentage of e-invoicing, but they also tended to have higher staff levels for the same amount of e-invoices. And they would take perhaps the most amount of time to approve and pay the invoices. And this was contrary to what I might have expected. So I just wanted to cast some observations and make some assumptions about why the data may be coming across this way. You know, one observation may be that a shared service organization may have a higher propensity to be leveraging outsourcing as a means of staffing and expanding its function as one for cost-cutting, labor arbitrage. And the recent research that I've done, and it's captured in a paper here, really points to the fact that companies now, even the outsourced providers, are shifting from simply a labor arbitrage model to a transformational model, or what I call the next wave of F&A outsourcing. And the transformational model, in almost every case, was adopting some kind of electronic invoicing as a driver for strategic cost savings. And so that these slides will be made available if that discussion for outsourcing is interesting. You can read that paper here. All right, so here we're talking about best practices, and that concludes that section, which concludes kind of a review on our survey results. There's a lot more detail to the survey, and we'll encourage you to download the paper and review the rest of the details at your leisure. again, our goal was to help educate you on how your competitors might be using electronic invoicing for strategic advantage. It's clear that electronic invoicing delivers far greater efficiency. Obviously, it's going to mean a cleaner environment. It's going to lead to other more strategic benefits. And you're going to have a lot of opportunities for selecting an e-invoicing solution. We wanted to take a moment to introduce Ariba to you, for those of you that may not yet be familiar with Ariba. Ariba has been around for over a dozen years in the e-procurement, in the electronic commerce space. And what we do is we help companies, simply put, improve the way that they buy, the way they sell, and the way they manage cash. We've got over 2,600 employees worldwide. We have over 730,000 businesses that are connected in our network, and they transact over 320 billion euros of spend, and they transact over 60 million invoices annually. Our solution is delivered in the cloud, which means that with a single point of integration, you can connect to all of your suppliers and automate all of your invoices. And we also offer services and the expertise that you're going to need to really jumpstart your program, and we'll give you the expertise then to help you measure and achieve the business goals that you've set out to achieve. Our invoice management solution, it's designed to help you capture 100% of your invoices in an electronic format, and we have an approach that we call 100 and 100 to get you to 100% invoicing within 100 days. And we do that by combining scanning with a strategy to migrating those suppliers to electronic invoicing. And as such, we also have a very significant supplier enablement team and large staff globally that's going to help target and onboard the suppliers that you need to have your program be successful. The next slide is a summary of some of the companies that have gone before you and are doing this very successfully today. I mentioned Deutsche Bank earlier in my opening comments. Caterpillar is another company, of course. If you're not familiar, they really are the company that builds the world's infrastructure. They design and manufacture, market, and sell machinery for infrastructure. Their results here are also very impressive. They've got 8 SAP systems, and they've connected all of those to a single instance of their business network, which is Ariba. And from that, then they're able to connect and transact with all of their enabled suppliers. And this has helped them move from a virtually all paper to what now is almost over, or 96, getting closer to 98 now, of what they call touchless processing, where they're no longer having to touch those invoices. So great story. There's others that you can read. This is just a sample of some of the other companies that are using Ariba for accounts payable, for invoice automation, and both on the buy side and the sell side. And it's a quick introduction. There are more of these archived webinars that I've done with Susie and we've done with many of these companies. I'd encourage you to go to Ariba's resource library. Here's a link here where you can get a copy of the survey results, and in that resource library you can also find these stories from the likes of Deutsche Bank, Caterpillar, and others to tell you what they've done and the approach that they've taken for accomplishing these things. Before we jump into Q&A, I would like to thank Susie. I would like to acknowledge the outstanding work that Sarah Fury, who is Susie's senior research analyst, that what she did on this survey. You can download a copy of the survey results, as I mentioned. And again, thank you, Susie, for you and your staff for outstanding work on the survey and for hosting this webinar. And with that, I'll turn things over to you for Q&A.
Thank you very much indeed, James. That's highly appreciated. So, we're just going to move to questions, but just before we do, a final poll for you, please. So, as many of you know, Ariba is one of our key sponsors at the Atlanta event that we've got, which is the Summit for Leaders in Financial Services, taking place in Atlanta in 2 weeks' time. They have procured 2 tickets. which they are going to be issuing to 2 lucky winners. If you would like to be included in that raffle, please let us know. So absolutely yes, please, I'd like to be entered into it. No or maybe. So I'll just leave that open for a moment as I move to questions. So a few questions for you, please, James. So question number 1. At what level is a business case viable for e-invoicing? Is there a certain threshold of invoices that you process per annum that you should have in order to engage in e-invoicing and expect to get some kind of ROI?
Yeah, I think we tend to use about 100,000 invoices annually as a sweet spot or a good beginning place. Of course, we have customers that have fewer than 100,000, but that seems to be kind of a good place to start. If you deal with 100,000 invoices or more annually, that's probably a good place to start. The other area I would add to that is you were talking about accounts payable staff and how many accounts payable staff do you have dedicated to the number of invoices that you process, and you might want to look at that ratio, and if you're at that sort of 13,000 or fewer invoices per staff, then you realize your efficiencies you're considered a laggard, you're below average. You have an opportunity for acceleration. But having a higher volume is definitely a major driver in the business case. The more you have, the faster your results will be. And that's a function of your suppliers that are sending large volumes of invoices. You want to make it have a solution that will help them make their process more efficiency and converting that paper to electronic, reducing the number of inquiries, et cetera. Yeah.
That takes me on nicely to my next question. So a question here that I've got, which is how do you apply pressure, or how do you persuade, or how do you work with large suppliers to switch to electronic invoicing? An issue that this individual is having is that they are coming across some suppliers who are potentially resisting. They want to know, how do you get access to the right level within the organization to motivate them to do e-invoicing?
Well, I mentioned Ariba's, the reason for Ariba's success is that we have built up a global staff whose sole job is to target and onboard suppliers on our customers' behalf. And of course, in the process of doing that, you build a best practice around it. You have the right training, the right set of competencies to do it effectively. Some companies try to do it on their own. Some are successful in it. Some are not successful in it. I would say partnering with your provider is key. Leverage the best practice that exists. You'll hear from other success stories one theme, which is you have to establish an internal policy. What is our policy going to be for e-invoicing? Will we mandate or encourage our suppliers to participate? And socializing and communicating that policy internally is paramount to success, and then socializing it and communicating it with your suppliers is also a key component to success. The mandate for participation, don't shy away from it. It's been proven to be successful regardless of the size of the customer, the buying organization.
Okay, and finally, just one question, please. So from a member that's tuned in, they want to find out about the balance between utilizing in-house resource versus external kind of supplier onboarding from a third party. What's the balance, and how much can this individual expect to get from an internal person to do actual supplier onboarding for e-invoicing?
Yeah, that's a great question. Like most questions around organizational structure, it's going to depend on the size of your organization, the complexity of the industry that you're in, and likewise with the suppliers that you're connecting with. But we have seen very successful programs that have as few as one person at the helm from a customer's perspective that's then leveraging our team for getting the scalability for reaching the targeted suppliers in the program. We've also seen our customers that have a much larger team that's dedicated to supplier targeting. What I would say is that, you know, we're really talking about shifting the roles of your organization. When a lot of people say, well, gee, we're eliminating headcount. There is some of that associated with invoice automation. What I like to say, it's more shifting roles, though. Instead of handling inbound inquiry calls, your job shifts to targeting suppliers, getting them onboarded for an e-invoicing initiative, and then some of the cost savings that we talked about before, discount capture, contract compliance, VAT and tax audit assurance, moving these resources into more strategic value-added roles. That's where the payback really begins to come.
Perfect. James, thank you very much. I'm afraid to say that we are now out of time, so